Well, good morning, everyone, and welcome to today's Succession Masterclass webinar. Today, we're talking about asset protection, specifically around structuring for succession, and that's all about who owns what. It's all about where we hold assets and why we might hold them using various structures and entities, specifically for protection. So let's start. Let's move forward and have a conversation around what that actually looks like in terms of how we use structures for succession planning or as part of our succession planning strategy. Before we do that, let's just quickly have a look at where we're up to in the series. I know some of you, I can see a list of names that have been on all of the first couple of webinars and looking forward to you joining us for the rest of them. This is webinar number 3 in a series of 10. We're doing them monthly, every month for the rest of the calendar year. So I hope you can join us for some at least, and hopefully more than that during that period, all around succession, etc. Looking to cover off on the various key topics, 10 of the key topics around succession and exit planning. A bit of background for those of you that don't know me. I'm the CEO and founder of Succession Plus, and it has grown over the last 9 years. We're about to hit 10 years next year, really focused on succession and exit planning. You may know I do a lot of work in the space of succession. I speak at a lot of conferences, obviously, but also a lot of work in the area of employee share plans. So we'll be doing a specific webinar on that topic in a couple of months' time. So again, and that's actually in August. So I hope you can join me for that as well. As a business, a couple of different partners in Succession Plus, all of us accountants by background, none of us doing much hands-on accounting work anymore, largely focused on the Succession Plus business and succession exit planning. We do have accredited advisors around the country. Some of those are online today. We've got 24, just trained another 6 or 7 only a couple of weeks ago, just before Easter. We're in most capital cities. We've got several country towns, etc., and we are still looking for people, particularly in regional areas. So if you're interested in being more involved, please reach out to me after the webinar and we can have a chat about whether that might work for you. There's a bit of information on the website there. Let's just have a look at the process and sort of where this fits into the overall succession planning strategy that we use. We use a 21-step process with all of our clients. Not all clients go through all 21 steps, but most of them cover a fair few of them, if not all of them. And several cases we do cover all of them. The issue we're covering today around asset protection really fits up the top there in stage 2. Once we've done our initial valuation and stage 1 report, the first thing we need to do is protect the value that we've already discovered. If we go and value somebody's business as $3 or $4 or $5 million asset, then we need to think about how we protect that. Firstly, we use financial planning and some structuring, and that's what we're going to talk about today. Secondly, we looked at unplanned events. What happens if you get hit by a bus? What happens if something goes wrong, or there's an accident or an illness or something else happens during the process of building your business that you hadn't planned for properly, and we don't want that to affect or put at risk the value that we've just created. And de-risking, which again is partly structuring. We're going to talk a little bit about de-risking today before we get into then stage 3 and 4 around maximizing value and growing the business, etc., on the way through. So let's jump into it. I guess the first point to start is really, what is this thing we're talking about? Asset protection. One of the things that we use is structures. The other one is business practices, and that could be simple business practices like simply documenting policies and procedures to reduce risk. Simply having in place some process to protect the business and its employees and its customers from an unplanned event, from an accident or a workplace incident or anything else that might cause a damage or problem within the business. One of the big things that we do, though, is structuring, and we're going to spend a fair bit of time talking about structures today to just try and see how we can use the structures to better protect ourselves and our assets and business, etc., and other shareholders. I love this quote from Henry Ford: money is like an arm or a leg, use it or lose it. But a lot of people forget the fact that, yes, you can use it, but how do we protect it? Once we've built an asset, and most businesses, no matter how small they are some sort of asset. Hopefully as they grow, they become a more substantial asset, and you do need to work out how best to protect them as you go. Why would you need them? Well, look, I think, unfortunately, there's some pretty scary statistics out there. New South Wales is one of the most litigious states in the world, not just in Australia, but in the world. And I think you'll agree that's becoming more and more common. There's lawyers advertising everywhere around class actions and claims and so on, and it's becoming more and more restrictive from a business owner's point of view. Certainly, I've read some information recently. I'm a professional director in a couple of companies and chairman of a not-for-profit, etc. And we're starting to see lots of cases where people in those kind of positions are held personally liable if, for example, there's a workplace accident and as a director you didn't do everything that was needed to do to protect that. So it is quite a risk that we're talking about. Look, obviously, as a business owner, every business has risks in it. Some are far more risky than others. If you're doing window cleaning on a high-rise building or you're repairing machines in a coal mining situation, that's obviously far more risky than running an accounting practice. But that doesn't mean the accounting practice is without risk. They've all got risks. And so we need to start to think about how do we protect? What's the issue that we're trying to look for? Obviously, business owners, certainly if you're a company director of any sort, whether it's your own company or you do that as a career, as a role, whether you're on the board of a not-for-profit, as I said before, anyone that's providing professional advice, certainly anyone that owns property or a property investor, and anyone that's high profile or public figure, obviously there's a whole stack of risks there. And we're obviously talking about lots of different types of risks. So obviously there's an employee risk. You see, I would say probably every day, if not certainly every second day, you would see something in the paper about an employee be with a bullying claim, a sexual harassment claim, unfair dismissal claim, and hopefully not too often, but we do see them, workplace accidents, etc. So there's lots of issues there. Consumer law, obviously customers, clients, purchasers, etc. Partners, creditors, the whole long list. Obviously, there's been a lot of media attention just in the last few days, actually, about the ATO and them taking, some pretty drastic action against businesses. I actually worked with a business who, through no fault of their own, had a payment for a BAS go through a couple of days late, literally, and the ATO served a garnishee notice on their bank with no notice, no advance contact, no phone call. Now, massive damage to the business, etc., risks, etc. So lots of areas to look at. The key thing to think about is, what's the most effective form of asset protection? Obviously, as I said at the start, you can't get this 100% right. There is no such thing as 100% asset protection. It just doesn't exist. You can do some things, though, to minimise risk. Certainly, sound business practices, and I said before, policies and procedures, systems, documented checklists around safety and even things like motor vehicle maintenance. If your business has a whole stack of vehicles on the road driving around, and there's businesses that earn all of their income through delivery and so on, service trucks on the road, servicing equipment, etc., then all of that can be documented. What is it in place that we need to check with those vehicles? How often are they serviced? Is the rego insurance up to date? Is there anything else we need to worry about, etc.? The right time to think about this, it's the same as I tell people about succession planning. Begin with the end in mind. Start as early as you possibly can. The problem is often we start in a smaller business and it grows substantially over time, and we end up with a major problem when we've suddenly got a business that turns over $10 million and it's got 100 employees. So start now. Think about asset protection all the time and review it regularly. Couple of key steps. There's 6 simple steps that I recommend to people that should be in place around protecting your assets, no matter what the issue. The first one is simple: own nothing. And that sounds quite ridiculous, but it's quite important. Often, and I'll show you in a moment, we have what we call at-risk individuals, and those individuals are typically directors, etc., of companies. It is best that they just simply own nothing. Step 2 is to quarantine the assets. Keep the assets separate from the risk. It still amazes me how many businesses start out 20 years ago. They'll go and buy the building that they operate out of, the shop or the factory or whatever it might be. They'll then add on some leases and some equipment and some other bits and pieces. And suddenly they've got this structure. Mum and dad, $2 shelf company. Mum and dad are both directors. They own the family home. They own the building inside the company. They've got all these other assets and nothing's quarantined. It's all in one bucket, if you like. Identify the appropriate structure. Start to think about, well, who should own which asset? I've got a number of different assets here. Is there risk in a particular asset or a particular structure? Is the business more risky than owning the building? And that's nearly always going to be the case. How do we protect that? What do we do to make sure that building is best protected whenever it can be, etc.? Create the ideal structure. And I'm going to show you the ideal structure, although that's a very difficult thing to do given the variety of different needs for people on the call today, just seeing what structures are available and how we might put them together to create the ideal structure. Insurance shouldn't be underrated. It's still needed. the asset protection in terms of structure and so on doesn't solve the problem. If you're going to have a motor vehicle accident, owning the vehicle in a family trust won't help you. You still need to have insurances, etc., in place, and obviously some legal protections. We're going to have a look at all of those and just start to see how we can combine those 6 strategies to come up with the best possible asset protection. Another great quote. This is really what we're talking about today. When I go into any business deal, my chief thoughts on how I'm going to save myself if things go wrong. Not expecting that they're going to go wrong, and certainly not hoping that they're going to go wrong, but having a plan in case something happens, having a strategy around it. So the first thing is step 1, own nothing. Move the ownership away from at-risk organisations and individuals. So if your company is a trading business, it has risk. Some more than others, as I said, but it still has risk. And so you don't want to have assets sitting in that entity. The same thing goes with organisations. The same thing is with individuals or people. We've still got the same risk where we've got at-risk individuals. We don't want them to own anything. House is a typical example. Lots of business people that I know of, in fact, I had one in my office a couple of weeks ago, very proudly tell me that through his business, he's been able to pay off his house, which is great. There's nothing wrong with that strategy, except that it now becomes a fully exposed $1 million asset sitting there. And it's in his own name. He's the only director of the company. If something goes wrong, it's a very, very valid target. Obviously, there's a strategy here. Now, there's a simple strategy. This is really easy to do. We borrow money against the home, we take a mortgage against it, etc. Now, people think, well, that means I need to go to a bank to get into debt. But no, that's not necessarily the case. You might mortgage that back to your family trust. It doesn't have to be National Australia Bank or Commonwealth Bank that holds a mortgage over your house. It's actually possible for your family trust to have a mortgage or security against your house because it's lent you $900,000 to invest in your business, for example, which gives you another level of protection because you then, or your family trust at least, becomes a secured creditor rather than the bank, or rather than having an unencumbered $1 million asset sitting there that's up for grabs. The other thing to think about is assets that aren't typical or that, not cash, not shares and property, but what about intellectual property? What about software you've designed? What about a database that your business has developed over 20 years that people often don't consider in terms of assets? And we need to think about all those assets. What are the assets that we're trying to protect? In some businesses, in fact, you'll see the major asset and the asset that contributes by far the most value is intellectual property, some sort of IP, some sort of design or process that they've designed and built over years and years, and it now becomes quite a valuable asset to the business. So we've got to think about those assets as well as just the assets we can see. The second thing is, obviously it's about quarantining assets, but we're trying to accumulate assets. As a business person, we're building up a business, we're taking out income, we're paying dividends, we're reinvesting it, we're putting money into super, etc. We're accumulating assets as we go, but we've got to be able to quarantine them. We've got to be able to separate them from the risk wherever we possibly can. And the simple way to do that is to create structures that make people and organisations that are not exposed to the risk the legal owners. So typically you'll see lots of my clients have the husband or the wife is the wife might be the CEO of the business, principal shareholder, director, etc. That means that the husband owns, for example, the family home, and he's not a director of the company. A lot of people make the mistake to put both partners in as directors. And as I tell people often, there's not much upside to being a director. There's a hell of a lot of risk, but there's not much upside or benefit. Step 3, start to think about the most appropriate structures. And we're going to go through some of these structures. I apologize I don't want to make this overly complicated, but I do want to go through some basic principles. So I apologize to those professionals in the room that already probably know some of this material. We'll move fairly quickly through it because I do want to talk about how we use them. That's far more interesting and important. The key thing here is identify the appropriate structure for the right asset. Obviously, the worst structure you can have in terms of asset protection is to be a sole trader. A lot of business people start out on this basis. So if you start out as a plumber, you've gone through TAFE, you qualify as a plumber, you start a plumbing business, Craig's Plumbing, and suddenly it's just Craig West trading as Craig's Plumbing. Well, there's absolutely no structure involved there. That's just you. And if something goes wrong, you're it, which is obviously, firstly, it's appalling for asset protection. It's also bad for taxation. There is not much benefit to being a sole trader. The advantage, I guess, it's really simple, it's easy, it's cheap, etc. But very, very quickly, any business will outgrow that structure and should not be using it, really. If you've got any sort of business at all, even if you're a plumber, as I said, that turns over 100 grand a year, you really shouldn't be using this structure. It's just not effective at all in terms of asset protection. It's also not great for taxation. So, it's certainly worth looking at. Partnership structure, this often occurs. We've got a plumber that's trading and suddenly his best mate's a plumber or his best mate's a carpenter, and they decide to go into business together. And so they simply form a partnership, and it's now Craig and Fred, and they're now in business together, and it's Craig and Fred's Plumbing. Partnership's sort of one step better than a sole trader, but not really. I mean, basically, you've got two sole traders in business together now. So we've got a partnership in there. There's now two people at risk. There's now two sets of assets. Depending on how it's offered, depending on how it's structured and what the documents say, there can be some limited amount of asset protection here, but really not a great vehicle to use. Again, fairly inexpensive to administer, fairly easy to understand, not fantastic for taxation because the income comes through to the individual, and so it's taxed at the marginal tax rate, which can be a problem if there's a reasonable amount of income available. But again, the key focus here, it's not great for asset protection at all. Company structure. Now, this is obviously really common. There's millions of these. Well, not millions. There's hundreds of thousands of these in Australia. Most reasonable sized businesses trade through a company. And this is the first time we've got a separate legal entity. So Craig's Plumbing, Craig West trading as Craig's Plumbing is Craig West. There's no other structure. There's no legal entity. For the first time now, if we've got a company, it's a separate legal entity to Craig West. So it might be Craig's Plumbing Proprietary Limited, and it is no longer Craig West. It's now an individual acting as a director of that company, but not necessarily and certainly not the same legal entity. So that does give us a level of protection. It's not fantastic, but it's okay. It's better than Craig West trading as Craig's Plumbing, where there is no level of protection at all. And that's an important point to understand. There's some additional regulation and additional cost to doing this. If you start to set up a company, you've got annual fees that are payable to ASIC. The separate entity needs to lodge a separate tax return to your own tax return, etc. So there's some significant, some increased costs, I guess, compared to the previous level. There is some ability to split income and provide dividends, etc., rather than working in our own name where all the income had to come through to our own return. We've also got the company tax rate, which at the moment is 30%, and the government's talking, as some of you know, about reducing that, but that's certainly the case at the moment. So there are some slight benefits here. One of the biggest disadvantages you'll see on that slide there, cannot access the CGT discount. So if you buy an appreciating asset in a company and sell it, as an individual, if you hold it for 12 months, you get that 50% discount. If you're a small business, there's some other concessions. The company itself can't access those, so you do lose some of that benefit. Some other structures just to look at, and obviously, in my view, one of the least understood but probably the most effective structures is a trust. And it's a difficult structure because it's a little bit more complicated than a company or a partnership, etc. But it doesn't need to be massively confusing. It doesn't need to be massively complicated. A lot of people are beneficiaries of trusts in Australia, about 2 million people. And really, it's about just understanding exactly what sort of trust you've got and how and why you might use that particular vehicle. Trusts have been around for many, many years. In fact, more than 1,000 years. They were originally set up in the Crusades when a knight travelled offshore, overseas, to go and fight. The property that particular person owned was basically held or managed by someone else on his behalf. So the simple concept, whilst there wasn't the documentation we have now, the simple concept is Craig West's going to go off and fight in some sort of war. I go to my next door neighbour who I know and trust and say, listen, I'm away. There's a bit of a risk that I'm not going to come back. Can you please look after my assets for the benefit of my wife and children, for example? And so in that trust arrangement, there's a couple of key things. Firstly, there's a grantor. There's a trustee, my neighbour, who's going to look after the assets for me. There's a beneficiary, in this case, my wife and children. And in informal contract, so on, there's a trustee. There's a document that actually sets out. And the trustee is simply a set of rules that says, here's how the trust's going to work. Here's how I want you to run the trust on the way through. Simply, when you look at the diagram on the right-hand side of the screen, you see a fairly simple structure. We have a director, so we normally recommend a corporate trustee, not Craig West as trustee for the West Family Trust. It should be a corporate trustee, so a company, a separate legal entity. Craig West may well be a director of that corporate trustee, but not always. Then we have the trust itself, which is the Smith Family Trust in this slide example, and we've got some beneficiaries that are sitting down there on the right-hand side. And those people, it's important to understand the distinction between the beneficiary and the ownership. The trust owns the property, not the beneficiary. So even though I've said to my next door neighbour, I want you to manage that, and the beneficiary is my wife and children, and I want you to look after them using that asset, they don't own the asset. I still own the asset. So it's being held in trust. So we just need to understand that's a fairly important aspect. What that means is if something happens and Craig West is suddenly a problem, if there's an issue or sued or something like that, then that asset is not actually an asset that would go onto the list of assets and liabilities of Craig West, because it's actually held by the trust. It's owned legally by the trust, providing all the documentation's right. Now, there's a couple of different types of trusts, just to make this a little bit more complicated. There's a couple of different types of trusts that you can use. The first one, and probably a fairly simple one, lots of people see these if you buy listed property trusts, for example, on the ASX. If you go and buy into one of those vehicles, you will typically be using a fixed trust. It's called a unit trust. They're fixed because the entitlement is fixed. So if there are 1,000 units and I buy 500 of them, I'm entitled to 50% of the asset and 50% of the income. They have some benefits. They can access the 50% CGT discount if those units are held by an individual. We can fix or apportion the equity interest, so we can actually easily see and determine who owns how many units in that trust and what percentage that equate to. We commonly use these structures as part of our planning when we do an employee share plan, for example, because if we've got 4 or 5 employees, we need to know how much of that asset does each employee own, and we use units to identify that and proportion that across people. On the other side, though, in terms of disadvantages, they are a little bit more costly and expensive to manage, establish and maintain. Difficult to retain income or capital gains within the trust. So unlike a company where we can retain our profits for future investment, etc., then we can't do that in there. If the units are held by an individual, we've got some issues around income splitting, and we've got to distribute that out, etc. So there's some disadvantage. The big disadvantage in bold at the bottom right there is if Craig West owns those units in that unit trust in his own name, the asset is just the units, and underlying those units is the asset that the trust holds. So there's not really a great level of asset protection sitting inside a unit trust. These are the common ones. So people would have heard of family trust before. This is the most common trust structure that's used. Commonly called family trust, they're typically set up by a family to manage the assets, typically investment assets, etc. Great vehicles for succession planning because we can manage control of the trust, etc. And we've also got an attractive range of benefits that sit with discretionary trusts. Firstly, they don't pay tax on income, but the income must be distributed out. So that's a different treatment, I guess, to some of the other structures that we were talking about. The trustee has discretion. So the word discretionary is really important here. The fixed unit trust, if I have 50 units and Fred has 50 units, there's no possibility other than to pay Fred $50 and me $50 if we're paying a $100 distribution. In a discretionary trust, we can do that quite differently. We might pay me $80 and Fred $20. And that can obviously be a very useful planning vehicle around the discretion to pay different people income, etc., and also capital gains tax. Much better for asset protection, which is really important. They offer excellent asset protection because the assets are not owned by the individual beneficiaries. Even though I can earn income out of that asset, out of that trust and the asset that sits within it, I do not own the asset, so it is quite separately quarantined. Again, a little bit more cost, a little bit more complexity and so on to manage this structure on the way through. Hybrid trust. Now, these have been around for a while. They're not very common, but some people do use them, and they're a cross between a unit trust and a discretionary trust. Generally speaking, it's quite flexible. It will allow you to gain some of the advantages that a unit trust gives you around things like negatively gearing investment, but also the advantages of the discretionary trust and so on. So quite an interesting structure to use. It's not as common as family trust or discretionary trust, but they are around and lots of accountants do recommend them and use them. As I said, there's a little bit more cost and complexity in these, but not a lot more compared to, for example, a family discretionary trust. Self-managed super funds. This is not a workshop on self-managed super funds. We will do that later on. But the big thing here to understand is, excuse me, these are self-managed super funds. The term a little bit confusing in some ways, but these are self-managed. They're DIY super funds, if you like. These are not the industry funds, etc. They are much more heavily regulated. And so you can't just set up a self-managed super fund and do whatever you like. It's not do it yourself at that level. It's do it yourself within a very strict framework of rules and regulations that govern what you can actually do. And of course, there's a primary purpose for these, and that is to fund retirement. And the rules that are written are largely around making sure that those assets that are held within the self-managed super fund are preserved for retirement. So there are some strict conditions around this, and I recommend you get very good advice. If you're going to go down this road and set up a self-managed super fund, or you've already got one and you're thinking about using it more to protect assets, etc., definitely an advantage, but you do need to get definitely some good advice. The advantages, much lower tax rates for self-managed super on purpose. This is not some tax scheme. The government has set the tax rates for self-managed super funds at a much lower level to encourage people to invest their money into superannuation to fund their retirement. There's some other benefits, certainly the income tax point of view, 15%. No further tax payable by the members of the fund in retirement. So once you retire and go into a pension payable out of that fund, then there's no income tax on the earnings. So there's some significant benefits. The big one for me, though, is this asset protection. There is massive asset protection benefit from using one of these structures. There is a much higher level of protection under the law than for basically any other structure. But there are some issues around managing the self-managed super fund. I would strongly suggest you get really good advice before you go down that road. Now, there's a balancing act going on here. You would have heard me in a number of those different structures talking about the differences between asset protection and taxation, and it's always a balancing act. So a couple of key things to consider. There's different tax rates coming into play here. One of the biggest problems with the complexity of our tax system is that there are different rates for individuals, different rates for companies, etc. And so there's the opportunity there to use that structure to manage the taxation cost, but also the asset protection. And you do have to balance. As I said before, trusts are not taxable, but the income and profits must be distributed. So you've got to be a little bit careful. If you've got two individuals as the only beneficiaries of a particular trust, you're going to have a problem, because those individuals, the money has to be distributed out to them, and not only that, but they'll obviously end up paying tax on it. This is the important point. There's a balance here. The best possible asset protection is probably a self-managed super fund, but that means the asset's locked up until retirement, which in some cases is perfectly fine. But in other cases, that may not be perfectly fine. It may not be what you're trying to achieve. The other structure that we might use is a discretionary trust, which is not taxable, but the income and profits needs to be distributed out. And so there is some trade-off there between asset protection and taxation. Now, creating the ideal structure. All those structures that we looked at are fantastic, but how do we actually use them in terms of what we're trying to do? Generally speaking, what we're trying to do firstly is, if you own a trading entity, so firstly, forget about trading as a sole trader or a partnership. That's very, very rarely the case. That should not be used. What we should be doing is trading is in a proprietary limited company. So at the bottom here, we've got our trading entity, which is Smith Engineering Proprietary Limited. We've got Mr. Smith, who's the CEO, etc. And they're both at risk. The company is at risk because it's trading. Assumedly, it's got employees, it's delivering product, it's got factory and machinery and creditors and all sorts of different customer issues, etc., etc. We've got risk down the bottom. Mr. Smith, who's also the director, he's at risk as well. He's going to have some risk as well. If something goes wrong with the company, he's likely to be involved somehow in that process. So the first thing to do is don't own the shares in your own name. Make sure they're owned by a discretionary trust. So on the left there, we've got discretionary trust number 1, which is the shareholder of Smith Engineering. And we've got some beneficiaries, Mr. Smith, his kids, etc. At the top, we've got a corporate trustee. So this is the entity that's managing the affairs of the trust and running the trust according to the trust deed, and that's a corporate trustee. And at the top, we've got a director of the corporate trustee. That might be Mrs. Smith, even though this diagram doesn't sort of show that. That may well be a separate individual. So that's the first point. The second point is we've got some investments. Maybe we put them in a separate discretionary trust. Now, this becomes more complicated, but there are lots of examples where businesses put, for example, the building. If you're going to buy the building, you wouldn't buy it in the name of Smith Engineering Proprietary Limited. You might buy it in the Smith Discretionary Trust or the Smith's Property Trust, etc. So it just gives you a separate level of asset protection by using that structure or that combination of structures. And lastly, we've got a self-managed super fund. Again, we set that up. It's got a corporate trustee, and we put our superannuation or long-term investment assets inside that structure so that we can see exactly what we've got and why it's there. Now, that combination looks a bit messy, but it's actually fairly simple. On the left-hand side, we've got our business structure, and we're quarantining that from the other two structures by having different directors and family trusts to own the assets so that they're not owned by Mr. Smith, who is the at-risk individual. Now, the next thing to think about, I love this quote as well, risk comes from not knowing what you're doing, Warren Buffett. Quite a useful quote, but there is obviously a couple of key things. Unfortunately, we often see people who've got insurance in place. I looked at a business recently, an architecture firm in Perth, and yes, they had some insurance in place for key people, but it was nowhere near adequate for the value. We just valued the business at 8 million, and I think the insurance cover was 2. I worked with a law firm as well where they had an agreement that sort of talk about what's coming up and, you know, their shareholders agreement. And if somebody leaves, we're just going to pay them out the amount they paid in at. Well, the amount they paid in at might have been $10,000 25 years ago. So it's a matter of just working out exactly what insurance do you need to cover all of these risks. And obviously there's lots of talk now about far more complicated business insurance cover than what there used to be 10 or even maybe 5 years ago. You can certainly see things like cyber risk insurance and you've got this data protection and privacy issue now where if something happens and your company's data is exposed to the public, then you've got some potential, A, you've got to notify, but B, you've got some potential costs and risk as well. So lots of different complication about what's going on in terms of insurance. But certainly, look, the smart thing to do is get a good insurance broker and get good advice around what are your risks and what needs to be protected. If you need help with an insurance broker or an introduction, I'm happy to arrange that. It's easy to do. I know a couple of really good ones. So just let me know, but certainly get a good insurance broker and talk to them about how to protect. There are lots of different options available now around insurance, and certainly new policies and new risk protection strategies. Legal protections. Law is king of all, apparently, and we do need to be careful here and think about, you know, the things. The key thing really is to document things to make sure there's certainty. We often see people that have even got insurances in place, you know, for business insurance, key person, etc., buy-sell insurance, but there's no agreement. Now, the agreement part is simply to provide certainty if something happens. If we have an incident, if we have an accident, if someone gets hit by a bus, what actually happens? And you'll see we're going to go through a number of different legal agreements, but all of them are simply about that. Let's find out about what's going to happen and document it so there's clarity and certainty around exactly what the outcome's going to be. The first one and the most basic one is to have a will and estate plan. Start to think about, firstly ask yourself, have you got a will and has it been updated recently? And if it hasn't, go and see a solicitor and get it done. It's not that hard, it's not that expensive, but it's really vital. And so many people in business, you know, they had a will drafted when they first got married is a common case, or maybe when they first bought a house. But since then, they've started and sold 2 businesses, they've opened another business, they've bought a whole stack of assets, they've been divorced with 2 kids, they've now been remarried with another 2 kids, and suddenly the will they had when they first got married is completely inappropriate for the position that they're now currently in. Second thing to think about is this idea of a testamentary trust. So under the will, we can actually create a new trust, which is only created when the person dies. But if something happens and the person dies, it simply means that you're not transferring. And I've actually seen this happen in a couple of occasions with clients where business person has protected his assets, put them in his wife's name, put the house in the wife's name, put some structures around in a family trust that the wife was the trustee of. The wife dies, and of course her will simply says, transfer everything to my husband. And so the whole problem has just gone all the way back to the husband being the problem, because now he's got all the assets and all the risk at the same time. So you can actually create a trust post your death that protects your assets as well. Financial agreements. I'm certainly not a lawyer, and I'm not going to give you legal advice about how this works, but certainly wherever you've got financial risk, and this is one area, and you'll hear a lot in the media with celebrities particularly and fairly wealthy people putting in place prenuptial agreements, etc. It's just another example of documentation to provide certainty. Documenting exactly what assets are covered, how they're protected. If you've got particularly blended marriages and mixed families, etc., which is far more common now than it used to be, then you need to think about that. And that needs to be documented somehow to protect them. So where to from here? I guess the key thing really is to have a comprehensive review of what you've got. Have a look at, and often the easy way to do this is to talk to someone like a financial planner and do their fact find, which gets you to list out all of the assets and liabilities and who owns what. What entities do you already have? What entities don't you have? Who owns what assets and how well protected? And then start to have a look at how you might restructure. Go and talk to your accountant and find out how you might restructure those assets to provide the best possible combination of protection, flexibility, taxation, business operation. You don't want to structure things so complicated that you can't run your business anymore. And then we go from there. Now, that simply is a process. We use a document called a structuring profile questionnaire. I'm not going to go through it line by line, but it'll give you certainly all of the details. Who owns what assets? What assets and liabilities do you have? Have you got an investment property? Is it owned by you? Is it owned by your wife or your family trust, etc.? What about other assets, other investments, shares, et cetera, et cetera? There's a whole stack of things to start to think about in terms of who owns what. Once you've got all that down, it's then very easy to sit down and talk to somebody and go through and plan how best to protect those assets. Do we need to move anything? Is there anything in here that's in the wrong place? And of course, you can't do that. This is an important point. You can't do that at the point that you sell. I've actually had an example of a client who's literally at the point of selling his business saying, well, we probably need to move this asset out of here. Typically, you'll see business owners have bought the family recreation. The car is owned by the company because that's the best thing to do with it while you're trading. But once you sell the business, you still need to keep the car. You've got to get that out. Hopefully not too much more complicated than that with things like businesses and investment properties and so on. I have seen several businesses where they've made investments that actually weren't to do with the business, but they've made them in the trading entity. And so that's a significant problem. If you go down the track towards selling, you've got these assets that don't really have anything to do with the business, probably not going to be part of the sale process, and then we've got a problem. Superannuation, obviously that's becoming more and more important as we've got lots of baby boomers that own businesses heading towards retirement, thinking about how they structure their assets, etc. That becomes a key area for them to consider. And the last one, or the second last one really, is this insurance issue. Just go through and review all of your insurances. If you're not sure, go and see an insurance broker and just get coverage. Coverage for lots of these things now is quite cost effective. I won't say it's cheap. Sometimes it's not cheap, but it's pretty much cost effective to protect the level of asset that you're trying to protect. Okay, so the conclusion really is just to think about a couple of key things. Spend some time, go through the asset protection issues, manage those, sort of make sure we've got some level of protection in place wherever we possibly can. Spend some time, effort, and possibly some money getting the right advice to make sure that there's a level of protection there. It's not worth spending your life building up a business and then losing it because of an accident or a claim or something happening. As I said earlier, we are recruiting accredited advisors. There's several areas where we still need to recruit people. If you're an advisor in one of those areas, I'd love to talk to you about joining us and working with us. We've got a fairly rapidly increasing demand, particularly in Melbourne, but also in lots of other areas throughout the country. We are looking to recruit people to join us and work with clients in those particular areas. As I said before, this is Masterclass is one of a series. This is the third one in a series of 10. So there are a number of upcoming events, one per month, starting obviously next month in May, where we're going to talk about the small business capital gains tax concessions, not successions, concessions. And then we're going to get into some specific topics around succession. Firstly, talking about family business and how and why that's quite different. Talking about what buyers are looking for and what they're worried about when they approach your business. We're going to look at the issue of employee share plans in August. Strategic sales. So what are buyers really attracted to? What's in the marketplace now that people are actually looking for to try and buy? The M&A process, we're going to go through that in a bit of detail. And then an action plan around delivering succession services through and with your client base. So love you to join us for any of those. As I said, they're all free. They are recorded, so if for some reason you can't join one of those particular sessions, they're all recorded and available. So please go onto the website. You'll find them all there. They're all free to go on and have a look, and you can actually sit down and listen to them at your leisure at a more convenient time if that suits you as well. We do have a little bit of time. It's only 11 minutes past 11 and we're supposed to finish at 15:15, so I do have a little bit of time for questions. If you're not sure about how to do that, the easiest way is there's a chat box on the bottom right hand side that is enabled now for questions. So if you have questions, please fire away and I'm happy to answer them as we go. So if you need anything or you've got questions on any of that material, I'm very happy to answer that for you as we go. Just simply type them into the right hand box and we'll go from there. I've got one question there already. So the first one is about the use of self-managed super funds and the fact that I mentioned, yes, so there is a lot more regulation around self-managed super funds. There's obviously regulation around companies and family trusts as well. But the self-managed super funds are not only covered by things like the Corporations Act, but there is a specific piece of legislation called the SIS Act, which is designed to supervise the operation of superannuation funds, both public and industry funds, but also self-managed super funds. And the key thing with the self-managed super funds is that it's designed to be run by mum and dad. If you're a business person, you can set up your own fund and so on and go and make your own choices about investment. But there's lots of rules, and the rules are specifically there to protect those assets for retirement. And in fact, one of the simple rules is that there's a primary purpose test, and you need to be able to show that that investment was related to retirement. So there's lots of examples. I haven't got time to go into them now. But for example, a couple of them are simple things like people that have gone and bought a whole stack of artwork and hung them in the house, not necessarily to fund their retirement, but to make their house more beautiful. That's an issue, and lots of others. So yes, there are some rules around self-managed super and asset protection. Another question around employee share plans. So we'll cover those separately, and I'm just looking for the date. That's actually in August. I did mention them because a unit trust is the structure that we use when we do an employee share plan. So that's certainly happening. Excuse me. So we can certainly cover off on that when we come back in August. That's on August the 9th, and you should be able to register for that already, but certainly keep that in the diary. A couple of other questions. Curious as to the suggestion of insurance broker rather than specialist advisor for the insurance component. Okay, so there is a slight difference there. When I was talking before about insurance, I was talking about things like cyber risk and directors and officers insurance, business insurance, etc. That would be for a general insurance broker. It is certainly right that you do often need a specialist advisor. If you're talking about buy, sell, and therefore life insurance for key people, then you do need a specialist advisor that does that all the time. It's not something that most general insurance brokers are probably familiar with. So thanks for that, Nadia. That's a good point. Is it possible to get a copy of the presentation slides? We don't email out the slides, but the whole thing is recorded and you can download the recording and play it at your own leisure. So the answer, Chris, I guess is sort of, but yes, you can download a recording and replay it whenever you like. So absolutely no problem at all with that. I'm not seeing any more questions at the moment, but very happy to answer more if they come through. My contact details should probably be on your screen right now. So if you do have other questions, please email them through or call me. I'm happy to have a chat to you either way. Thank you for joining us, and I hope you can join us again in May when we're actually looking at the topic of the small business capital gains tax concessions, which is pretty relevant for succession planning as well. Thanks again, and I look forward to catching up with you next time.